Let's look at NIO stock. We'll cover what's happening, examine its volatility and volatility smile, and check the trading volumes. I'll also demonstrate a simple strategy that allows you to earn money with minimal risk regardless of the stock's direction. Let's start with the stock itself. After a substantial drop of 20%, it has been in consolidation for several weeks. Let's look at the volatility. Then, I'll show you the financial metrics of this company. As we can see, volatility across all expiration dates is gradually decreasing. This is normal because the company has released its earnings report, which typically leads to increased volatility and uncertainty. Once the report is out, the company's volatility naturally declines. Consequently, the longer the stock remains in a sideways trend, the lower its volatility will be. For some strike prices, volatility is already down to 57%, which is very low. Now let's look at the volatility smile. As we can see, it might be a complex graph for some, but I'll try to explain how it works. We have different expiration dates indicated by dotted lines of different colors. We see that for closer expiration dates, volatility increases both for upward and downward movements of the stock. This means traders are anticipating that the stock could either rise or fall in the short term, making the cost of call and put options approximately equal. However, if we look at longer expiration dates, we see that volatility increases more for the downside of the stock, i.e. for put options. Volatility does not increase as much for the upside, i.e. call options. This indicates that investors expect the stock to fall in the longer term. Additionally, investors and traders are hedging their purchased shares by buying put options, which is why put options are more expensive than call options. This is a normal situation. Now, let's look at the historical and implied volatility. The historical volatility is represented by the gray line, while the implied volatility is represented by the white line. Currently, these volatilities are approximately equal. Yes, they differ for some expiration dates, but on average, they are equal. This is a healthy situation when both volatilities are equal. I always remind you that volatility tends to revert to its historical values. This reversion can be profitable, but right now we cannot take advantage of it because it is difficult to predict where volatility will go since it is already around its historical levels. This is the bad news, as it makes it challenging to determine the direction of volatility. However, I will demonstrate a strategy to play on volatility. For example, let's say we predict that volatility will increase by 15% by mid-August. An artificial intelligence tool can help us choose various strategies. I'll demonstrate one such strategy. We are suggested to sell a call option with a $4 strike, buy a call option with a $5 strike, and buy a call option with a $6 strike, all with expiration in mid-August. This strategy is quite complex and needs to be managed actively, but it is designed to capitalize on an increase in volatility. I am simply demonstrating that you can trade not just the stock itself, but also its volatility. Now, let's look at the support and resistance levels. We see a significant volume concentrated around the $4.50, $5 levels for call options. This is something we cannot ignore, as we see that the $4.50 5 has been a tough barrier to break. Even today, there was an attempt to break through it, but it was unsuccessful. Someone might wonder why we couldn't surpass this level. The reason is the large volumes concentrated at the $4.50 5. However, if we break through this level, the next significant resistance will be at $5. Why is this important and what should we do first? These levels don't break easily, they can only be overcome with large volumes. For instance, if there's a positive news release or an earnings report or some other trigger, the stock could surge above $5. Once this resistance is cleared, there would be no immediate resistance above, and the stock could start rising without limits. This was the case in 2020. We saw certain levels like $8 which were quickly broken, leading to a substantial rise until a new resistance level formed from options. After consolidation and retesting these levels, the stock broke through again and continued to rise. This cycle repeats until eventually, if no more resistances are left, the stock can rise significantly, gaining 10 to 20% daily, potentially doubling in a few weeks. This is what happens when there is no resistance. For now, the $4.50 5 is a key barrier, and we need to watch it closely. The good news is that the $4.50 5 options expire at the end of this week. A lot of volume is concentrated on weekly options, meaning that by the end of the week, these levels will redistribute. We'll need to watch where traders move their options next, as this will influence new resistance and support levels. The concentration of options on weekly levels also adds to the stock's instability. Now, let's focus on the financial metrics. The company is considered significantly undervalued with a fair value around $13. Yes, it was overvalued at some point, but currently it is undervalued. Operationally, the company is still unprofitable, but it has impressive growth metrics. Analysts predict revenues of $10 billion by the end of 2024, $13 billion in 2025, and $15 billion in 2026. Naturally, net losses are also expected to decrease, and the company could become profitable eventually. Looking at the debt levels, the situation is healthy. The debt level corresponds to the cash on hand, meaning the company can pay off its debt immediately. This is a very healthy financial situation. As we can see, there is an additional issuance of shares. This isn't great news, but on the other hand, the company needs financing, and for the future, this is quite normal. Yes, this is one reason the stock price is currently low, but in the long term, if you believe in the company, this is a normal situation. Other indicators are generally looking okay, considering the company is still developing. Indeed, the company is currently unprofitable and will continue to be so in the near future. However, if you believe in the company, it has the potential to grow significantly. Now, let's look at where the price might go in the near term. I always remind everyone that I do not know where the stock price will go and I cannot predict price movements. My main task is to manage positions and portfolios wisely. I have constructed a strategy using options. As we can see, we start to make money if the stock rises above $6 or falls below $3. If the stock rises sharply, we profit, and if it falls sharply, we also profit. The strategy is simple and consists of buying options. However, there is a high risk of losing money with this approach. I do not recommend opening such a strategy without proper management. It's crucial to manage the risk by selling options to hedge potential losses. I am just demonstrating what this might look like. Now let's look at the market forecast. The market predicts that by the end of the summer, the stock will be between $4 and $5. The current range is being maintained, which is perfectly normal. Now let's look at the forecast for the end of the year. The market predicts a slight decline in the stock price, estimating a range of $3 to $4. This suggests a small decrease in the stock's value. Again, the market incorporates all available information into its pricing. If any new information arises, the market will adjust accordingly. Practically all stocks are expected to decline by the end of the year, likely due to an upcoming recession that could begin later this year. This calls for caution. Based on financial metrics, market forecasts, and analyst predictions, the stock may continue to decline or remain at these low levels in the short term. However, in the long term, this stock has significant growth potential. A reasonable target could be $10, which is achievable within this or the next year. Reaching previous highs of $50 to $60 is also possible. Since the stock has reached those levels before, it is not out of the question to do so again. This will take time, and the company needs to increase earnings and eventually become profitable. If nothing catastrophic happens, the company could eventually surpass these historical highs. Patience is key. For long-term investors, this is positive news. It doesn't matter if you buy at $5 or $4 if you plan to sell at $50. I also remind you that I have started a new experiment with a portfolio built from scratch. There I explain how I form the portfolio and the principles behind it. I have already bought the first stock. Be sure to check it out to see what and how I am doing. Best of luck to everyone.